Welcome to Stock Talk with Nico Criticos. Today we're going to be taking a look at Tyson Foods, ticker TSN, and we're going to do some stock analysis to see if this stock is a good investment. So first thing we're going to look at is the stock chart. In the last 5 years, this stock is down 12%. In the last year, this stock is down over 36%. So it has not had a good year. The market cap on this company is $21 billion. And about a month or two ago, I started picking up shares of this one right about at this $60 mark. It really hasn't moved too much from this point. So that's where we're at with the stock price. Two pieces of news I want to point out first is one, they have started experimenting with using self-driving trucks to transfer their food. So that's one good sign. Then the other thing that came out today is that they are cutting 10 to 15% of their corporate jobs and senior leadership roles in efforts to cut costs and increase profitability for this company, because that's something they're struggling with. And if we go to see what analysts have them doing for EPS, we see that a year ago they did over $8, and that's when the stock was, nearly $100 a share. And this year it's expected to only do $4.30 of EPS, and the following year a little bit over $5. So EPS is expected to be half of what it was about a year ago, and that's why the stock price is nearly half of what it was a year ago. So this number should actually be a little bit higher now, because if they're putting in efforts to cut costs with cutting jobs and with doing things like autonomous trucks, then, which maybe at first the autonomous trucks, because I read that they're actually going to have somebody in the vehicle at first, so we may not see a huge change in profitability due to that until, who knows, months or if not a year plus later on. So we'll see what happens there. But the bottom line is I would hope and I would expect this EPS number to be a beat for this company for this year. So let's get started. What we're going to do is we are going to take a look on their website, and we're going to see that Tyson Foods is a modern multinational protein-focused food company that produces about 20% of the beef, pork, and chicken in the United States. That's the important part here. They have 20% market share in those three meat categories. That's why I bought this stock. And they own a portfolio of brands like Tyson, Jimmy Dean, and a bunch of other brands. They also deliver food to restaurant chains, hospitals, schools, military bases, a bunch of different things. So that's the other thing I like about this company. There are several competitors, but I think that the market share they have is significant enough. And this stock right now is pretty much priced worst case scenario. Like, I don't know how much more this stock could go down. So even if it is a slow ride back up to $90 a share, $100 a share, it might take a year or two. But I think I'm always looking at risk to reward profile and if I feel safe in this investment. So if we go ahead and we're going to look at one more thing here. It's going to say this website says that they're estimating 26% of total industry revenue this says their largest market share is in chicken and turkey, but where they account for nearly 26% of total industry revenue. So that's another thing I like to see. If we go ahead and get started on my checklist, the first things we're going to look at are revenue and net income. And what we're going to see for those are revenue is growing at approximately 6% a year or so. So not amazing, but good enough. The last year they did $53 billion. And keep in mind, this company is now valued at about $21 billion. For net income, we're looking at even more growth. We're looking at an average of about 12%. I like to look at the last 5 years. So we're going to say they're growing net income on average of about 12%. And last year they did about $3.2 billion of net income. So that would mean we're at about a price to earnings of 7, right? Really less than 7, a little bit under 7 based off of last year's net income. Now, if net income is going to drop in half like it's expected to do, then that PE ratio is now going to be about a 14, right? So we're going to get to that in a second, but just keep that in mind. Then actually, here we go. Let's look at price to earnings. We're going to see that this has it at a PE of a 9. That's not super accurate because as we just saw, it's about a 7. And then if they do $1.7 billion of net income, and we're looking at a $21 billion company, think it's $21 billion, then that's going to be about a 14. So in the last decade, as you can see, the highest it really gets to is about a 16 or 17. The cheapest it gets is about a 7. So right now, if we're looking at a 14 times earnings, that seems expensive. I would not buy it for that price, even though I did. And that's because that is a extreme scenario where their income is literally going to be dropping by 50%. That does not happen very often. And I think they will get back to $8 of EPS in the upcoming years. So really, you could say I'm buying this stock for a PE of 7 if you believe that they will get back to $8 of EPS, which I do. So that's why I would still say this is I mean, even if you're looking at it from this perspective of a PE of 9, it's still historically cheap. So that's why I'm going to give number 3 a check. Number 4, I'm going to give a check as well because they're innovative in the way that they are using electric trucks now. And their moat is that they have significant market share of 20 to 26% in various meat categories. So that's where I'm going to give that that's why I'm going to give that a check. Is the industry growing? Yes, I think it's like 3% a year for the meat industry. Nothing great, but it's good enough. Respectable return on invested capital. Here we are going to see their numbers are about 14%, somewhere between 10 to 15%. So that's good. That's not amazing, but it's good enough. Is their equity growing without goodwill? Well, if we go to their balance sheet, what we're going to see here is that their goodwill is actually $16 billion, which is a lot. That's a big chunk. That's nearly half of their assets are in intangibles and goodwill. I don't like to see that at all. That's not good. So that makes their balance sheet look a lot worse because instead of saying they have $19 billion of equity, I'm going to say they have more like $2 to $3 billion of equity. So we'll say $3 billion of equity. So, but the question is it growing? And it is growing. 14 billion to 19 billion in the last 4 years is good. So that's going to get a check. Now, is it over 15% of the market cap? I put barely, which it's a yes, but it's barely because it's only about $3 billion out of a $21 billion company. Then we're going to look at the share count. And for that, we're going to see it's pretty much flat. They're buying back less than 1% of shares. So it's pretty much flat. So that's fine. And assets minus goodwill are definitely not 2x the liabilities. So that will get a no. Is the profit margin over 10%? No, it is not over 10%. It is only 6%. So not the greatest there. Are there cash and receivables more than average annual income? This is another thing I don't like. It's just these little details about the assets on their balance sheet. And those are the only things I don't like. Cash and receivables. We're looking at what? $3.5 billion. And well, I guess you could say, okay, let's do it here. This is what we're going to do. Let's go to their most recent quarter. In cash and receivables, we're looking at, see, it came down a lot. They spent some of their cash. Now it's more like, let's say $3 billion. Okay. And is that more than their average annual income? Well, I guess you could say so. It's pretty much the same as what they did the last 2 years, and it's more than previous years. So we'll give that a yes. That's a check. And then their dividend is very healthy. They are paying a 3% dividend right now with a payout ratio of only 27%. So really, they could double that dividend to 6%, no problem, and they could have it still only would be a 50% payout ratio. That's a very healthy dividend. Let's see if they're growing that dividend. Yes, they are. In the last 10 years, so something happened between 2013 to 2019 to where they were nearly doubling their dividend every year, it seemed like. So right now, it looks like it's growing at about 5% per year. So that's another great sign. That's a very strong, a 3% dividend with a 27% payout ratio is very strong. And this company is over 20 years old. So it's founded in 1935. All in all, this stock will score a 12 out of 14, a very high score. And that's why I would consider this stock a buy, just because I don't think it's a high growth company. I understand their profitability is at risk for the upcoming 12 months. But as we saw today, things are coming out just like other companies, a lot of companies are firing people to raise profitability, and that's what this company is doing. So I feel safe in this company who has it's not like I'm always looking at what type of moat do they have and how easy would it be for another company to come in and replace them. I don't think this is an easy company. This is not an easy company to replicate. So it's not like anybody can just wake up one day and start a food company and get 20% market share in United States beef, pork, chicken, and turkey. That doesn't happen. So that's why I feel kind of safe. If things stay really bad for this company, then yeah, maybe it'll remain a $60 or a $50 stock. But for one, I'm still getting a dividend. And two, that's worst case scenario. I don't see me losing half of my money and this going to $30. I don't think that's realistic. So that's why I am bullish on this stock. So thank you guys for watching, and I will catch you in the next video.